So the election of Mr. Trump was a surprise for the markets, of course. But as soon as his first speech came out, he started to cool the markets. Essentially, he was moderate and he focused his speech on two things. First, a stimulus package decreasing taxes for individuals and corporations. And secondly, spending in infrastructure, essentially. Those Keynesian measures did cool the markets, but also increased bond yields very substantially. The markets are beginning to anticipate, first, that the US economy will grow more rapidly, and secondly, that inflation could be on the rise. So the markets are beginning to anticipate more inflation also. As we have seen, we had a big move on the bond markets after the first speech by President Trump. We adjusted our short-term targets, especially on the bond yields. So now we expect the 10-year Treasury to move to 2% over the next 3 months, and we expect the Bund to go to 0.2% again for the next 3 months. Nevertheless, we stick to the view that the Fed will rise interest rates once in December and 2 times next year, always by 25 bips. Overall, we did not change our target for the US dollar, which we expect to stay around 1.08, meaning that eventually we will have an overshooting for the short run, but we believe that other factors will limit the volatility of the greenback. We stick to the positive view on risky assets thanks to 2 positive fundamentals. One is that economic growth is still well-oriented. We see that with the leading indicators, PMIs on a global basis or ISMs in the US are telling us a strong story for services and a recovering activity in the industrial sectors overall. It has an important implication for corporate earnings. The earnings season for the third quarter is perfectly positive for the US market, where we have, for the first time in 5 quarters, positive earnings growth. And it's also positive for Europe, where we have also a good earnings season right now, even if we are in the middle of it. Overall, we stick to the positive view concerning stock markets, with a preference for Europe and Japan, and with also a neutral but positive view on the American market. We still need to monitor the political risk. In the US, we have to watch carefully what the Trump administration will do concerning 3 aspects: the immigration, the risk of protectionism, and the risk concerning the independence of the central bank. But more importantly, we have the political risk in Europe with several elections. Number 1, in December, the referendum in Italy. It's very probable today that the no will win, meaning that the Renzi government will have to resign. We expect a second Renzi government to start, because everybody would like to avoid general elections in Italy. And then, in 2017, we have several important elections. First of all, in the Netherlands, with a general election in March. Then we will have the French presidential election in May, and the general election during the autumn in Germany. So the political risk has to be managed. Thank you for your attention.